It's time for Wealth Wednesday with Yvonne Delry, investment specialist from FirstOntario Credit Union and Aviso Wealth. Today we're talking about tax-free savings accounts, otherwise known as TFSAs. What makes them such an important part of your financial, your whole picture financially?
Yeah. Well, they've become a more important part as an investment account. So they were introduced by the federal government in 2009. And as we've had contribution limits every year added on, the value becomes significant. So to recap, tax-free savings accounts can be used by every Canadian resident. You don't need to have earned income. Okay. You do need to have a valid social insurance number, and contribution room accumulates after age of 18. Okay. So if you were 18 in 2009, contribution limit for 2025 is $7,000, so you can have of your own contribution money $102,000. So that's a significant value.
That's a really significant value.
Yes.
Yeah. So how can the TFSA help you save and achieve your financial goals?
So one of the key features of the tax-free savings account is that you can use it and reuse the contribution limit for any of your savings goals. So if you have a savings goal of purchasing a new vehicle, maybe a significant vacation, renovation, use the tax-free savings account to save for those goals because all of the growth is tax-free. But then when you achieve the goal, remove the funds, but dollar for dollar what you have withdrawn gets added back to your contribution limit the following year. So contribution limit is calculated by adding that year's contribution limit, any carry forward room that you haven't used in previous years, plus the dollar value that you withdrew from the previous year. Tax-free savings accounts can also be used in tandem with other investment accounts. So if you have used the full value of the other investment accounts, either the annual or the lifetime, use the tax-free savings for the additional savings if you wanted to save additionally for that purpose. So RRSPs, first home savings accounts, and that type of thing.
So TFSA is a bit more of a short-term investment, more like a car or something like that, not so much for your retirement, but it works with retirement savings.
And I get asked this so many times, tax-free savings, RRSPs. So they both have got key features and are beneficial. But the main difference is that RRSPs, when you make the contribution, they become tax deductible and decrease your tax liability because they are deducted off your taxable income. But it just pushes the tax liability forward. When you remove the money, it becomes taxable income. Tax-free savings accounts is after-tax money, which means that the contribution is not deducted off your taxable income, but it does not get added on. So if you are in retirement trying to diversify your income, then you can have RSPs, which is a taxable income, tax-free savings, which is not, which is important for any kind of income structured government program, OAS, guaranteed income supplement.
Okay, so a very important account. We have 30 seconds left. Is there any other advice you have for someone who's opening up their first TFSA?
Yeah. So the other important feature is that the growth is compounded. So if grows tax-free. So if you have a long-term strategy, then compounding that growth without having the erosion of taxes on it can keep up with cost of living and keep your growth intact for you.
Okay,
Dream, plan, achieve.
Dream, plan, achieve. Okay, all great advice. Thank you so much. We'll get it up on our website, and we have more Morning Live coming your way right after this.